In this video, I'm going to show you how you'd calculate a company's book value per share, and then I'm going to show you how you'd interpret that. So here's the basic formula. You take a company's common stockholders' equity and you divide it by the number of common shares outstanding. Now, if you're thinking, well, what is common stockholders' equity? Okay, that's just the company's total stockholders' equity minus its preferred equity. Okay, so this bottom equation and then top equation are equivalent. I just wrote the bottom equation so you could see how common stockholders' equity is calculated. Now, remember, the total stockholders' equity is just assets minus liabilities. Okay, so common stockholders' equity, which is the book value of the company, okay, so common stockholders' equity is just net assets, assets minus liabilities, minus preferred equity. So in theory, what this book value represents, so the numerator right here, common stockholders' equity, that is in theory the amount of money that the common stockholders would receive if all the company's assets were sold for their book values, that's the value on the balance sheet, and then all the company's liabilities were satisfied. Now, the book value here, this common stockholders' equity, that is not actually in reality the amount that common stockholders receive if the company was liquidated. And we'll get to that in a minute. Okay, but in theory, this is the idea. Okay, so we're trying to say, okay, if all the company's assets were sold for their book values, the liabilities were satisfied, how much money would each shareholder get? Now, why do we care about this? Okay, so you'll hear about this sometimes if you watch financial news channels and stuff. People talk about the book value of a company and using it to determine whether a company is undervalued. Okay, specifically, they'll look at the market value of a company per share, so its stock price, and if the stock price is lower than the book value per share, then a value investor would say, look, you should buy that stock. Okay, that stock is cheap because its book value, so it's basically trading at an amount that is less than its book value. Okay, so you see that this company is really trading at a discount and you should invest in it. Now, let's look at an actual company. I'm going to show you how to calculate the book value per share for an actual company. So we'll look at Procter & Gamble. Okay, so Procter & Gamble Consumer Products Company, these amounts are in millions. I went to two of their balance sheets. Okay, so I got the balance sheet as of June 30th, 2020 and the balance sheet as of June 30th, 2021. So I'm going to be able to calculate the book value per share as of each date so you can see two different dates. Now, we've got the total stockholders' equity for Procter & Gamble. We got the preferred equity. So we just take this, okay, so this amount here for June 30th, 2020, $46.878 billion. Okay, because these amounts are in millions. Okay, and then you subtract the preferred equity of $897 million. So you take this minus this, and that gives you the common equity, $45.981 billion as of June 30th, 2020. Now, divide it by the number of common shares outstanding for Procter & Gamble. That's this amount here. So you take this, divide it by this, and that gives you the book value per share as of June 30th, 2020. Okay, so the book value per share, these per share amounts are not in millions, by the way. So the book value per share was $18.54 as of June 30th, 2020. Now, I went and looked up the stock price at the end of the day on June 30th, 2020 for Procter & Gamble, and it was $119.57. Now, I also did these calculations over here for June 30th, 2021. Again, to get the common equity, you take the stockholders' equity minus preferred equity, then you take this divided by common shares outstanding, and you get $18.84 book value per share. And again, we have the market value much larger, more than 6 times larger than the book value per share. Okay, now, so according to a value investor, this would not be a great deal because we see that the market value is actually much higher than the book value. Okay, so this would not be, oh, this is a discount. So let's say that the market value was not $119 on June 30th per share. Let's say that it was $15. Okay, so if the stock price was $15 a share on June 30th, 2020, a value investor would say, hey, look, the book value per share is $18.54, but the market value is just $15. That stock is undervalued. We should buy that stock. We should buy Procter & Gamble, okay? Now, that was not the case. We see, again, that the market value per share is much higher than the book value per share. And that, for a lot of companies, for most companies, the market value per share usually is higher and sometimes significantly higher than the book value per share. And that's for a couple of reasons. Number one, some things that we view as assets, things that have economic benefit to the company, are not recorded at all on the company's balance sheet. For example, the company's brand value. Okay, Procter & Gamble has a lot of different brands that they've owned and developed over the years, but you don't have internally generated brand value does not appear on a company's balance sheet. Okay, you don't record that as an asset. It's not consistent with generally accepted accounting principles. Okay, so the brand value that Procter & Gamble has generated over the years, don't put that on the balance sheet. So okay, that's not appearing in this book value per share. It's not capturing that because, again, book value per share was just the company's assets minus the liabilities, minus the preferred equity, and then just divided by the number of common shares outstanding. Okay, so there are some assets that are not recorded on the balance sheet, but we know they have value. Okay, and the market value is capturing that because investors see that value. Then also there are some assets that are understated on the balance sheet. For example, a trademark. Right, trademarks do not. If Procter & Gamble registers a trademark for one of its products, that trademark would not appear on Procter & Gamble's balance sheet at its fair market value. It'd be at the cost to register the trademark, plus any cost to defend the trademark from litigation and so forth. So it's not on there at its fair market value. So for those reasons, we can clearly see that the market value of a company is usually much higher than the book value. Okay. And over time, we've had an increase in the amount of intangible assets that companies have on their balance sheets as opposed to hard assets, like things like property, plant, and equipment, okay, buildings and so forth. So over time, we've had more and more intangible assets that companies are recognized as a higher proportion of their assets. And so that has led to the book value per share concept actually having less relevance to investors. Because, again, book value per share is in theory telling us, if all the assets were sold for their book values and then we, satisfied the liabilities and so forth, what are the investors going to be left with? Okay, but the book value really isn't telling us what the liquidation value of the company is because, again, we have a lot of assets that are either not on the balance sheet at all or they are understated on the balance sheet. However, you should still know about book value per share because you will, if you follow financial markets, hear people say, wow, this company is really attractive. They've got, their stock price is actually trading or their stock price is lower than their book value per share. So actually, you should go out and think about buying that company. So this is a key tenet of value investing. But again, with the rise of intangible assets and the way we value assets on the balance sheet, book value per share isn't as relevant as it once was.